So with so many option strategies available for you to choose from, which one is the best for a new options trader? I get this question all the time. What is the best option strategy for the beginner? Somebody that wants to trade, maybe make a little money, but they don't want to put a lot at risk. What is a good safe strategy to start with for the new options trader? Well, in my opinion, I think the best strategy to start with, as far as the least risky, but one that will make you a little money, is selling put credit spreads in products like SPY or QQQ. The reason put credit spreads are fantastic, especially for a new options trader, is because they're a defined risk trade. Depending on how you size it, you can size it to where it's a really tiny baby kind of trade where you're risking very little money to make very little money, or you can take a little more risk, potentially increasing your risk but also increasing your reward. But in the end, as long as you manage your size appropriately, you don't take too many trades and you don't take too many really big trades, as long as you manage your risk, you'll be okay with put credit spreads. You really are in no danger of blowing up your account unless you do something kind of wild and crazy. So over in the DT Options Discord server, I've been running a little put credit spread campaign in both SPY and QQQ, and we've been running these rather successfully here in the last, I started this 3 months ago. I started at the beginning of September selling a put credit spread every week or sometimes every other week in SPY. And then this was so successful, I started doing it in QQQ as well. I started the 1st of October doing a put credit spread every week or every 2 weeks in QQQ. And if I take a look at my chains here, the order chains, you guys can see these put credit spreads have been rather successful. I closed this one for a winner in QQQ. This was a winner in QQQ. Closed this one for a winner in QQQ. And this is the open one right here that I just opened yesterday. If I take a look at SPY here in the order chains, you can see I've run several of these on SPY. Winner, 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 and then I've got this one open. Actually, this one here, even though it's a winner, it's an unrealized profit. That one's still open as well. You can see I've got 2 put credit spreads going right now in SPY, 1 put credit spread going in QQQ, and these are rather simple trades that just kind of make a little money. I've been keeping a spreadsheet running as well of these trades and just keeping a log for myself. Now, I'm not much of a spreadsheet guy. I typically don't really fool with spreadsheets. I make thousands of trades every year, thousands of options trades. I'm not going to keep a log of all of them. That's too much work. But because of this put credit spread campaign idea, I did want to keep track of just the put credit spreads going in SPY and QQQ. So I have been keeping a running total of these in a very simple spreadsheet where it calculates the running P&L. So when I enter my profit here, say this particular put credit spread in QQQ, I make $55, it will update the running total. It doesn't update the chart. I have to manually update the chart myself, but that's not a big deal. I'm sure there's a way to actually get that chart to automatically update itself. But again, I'm not a spreadsheet guy. But anyway, I've just been keeping a log here right now. 100% winners on these put credit spreads. Now, obviously, I'm not going to win on all of these put credit spreads. I'm going to have some losers, but for the most part, these are pretty safe trades. Now, you probably want to know the rules for my put credit spread campaign. Well, let me go ahead and show you guys my put credit spread plan here. So let me zoom in on this document here so you guys can read. So the plan with these put credit spreads is very simple. You can see we're going to sell a 60 DTE put credit spread in SPY every week on Monday. So every Monday you will find an options chain for SPY that has exactly 60 DTE. That's why we chose 60 DTE on Monday. Now you'll do this every week as long as you can accept the risk of the trade. So if you got a smaller account and you don't want to have too many of these on at a time, what you can do, sell them every 2 weeks on Monday or every 3 weeks on Monday at 60 DTE. You can reduce the number or increase the number of these trades appropriate for your account size and how much risk you're willing to take. Now, as far as the deltas, we always sell the 35 delta short put, and then we buy a put 5 points below. And that's typically around the 30 delta put. And this ends up creating a put credit spread spread where your max risk on the trade is around $400, your max profit on the trade is around $100. And the reason it's a 4-to-1, it makes $500 because it's a $5 spread, right? If we buy the put $5 below the short put, that's a $5 spread. That means $500 is between the spread. That's always going to total your risk versus reward. So we're risking 400 to make 100, but these are not exactly what we're risking to make, because we are going to manage these early. We're going to exit these at either 50% max profit or at 21 DTE, whichever comes first. So we put it on at 60 DTE. If we reach 50% max profit, which is going to happen most of the time, when you reach 50% max profit, you take off the trade for a win. If you don't reach 50% max profit prior to 21 DTE, at 21 DTE, you take the trade off regardless, for a winner, for a loser, for a scratch, whatever it happens to be. At 21 DTE, the trade comes off no matter what. If you hit 50% max profit before 21 DTE, you take it off for a winner. And that's why risking 4 to make 1 is not exactly right. You're actually, your reward on the trade's 50% of 1, so it's $50, and your max loss is nowhere near $4 because that's holding it all the way to expiration. Because we're exiting 3 weeks early at 21 DTE, you're never going to come anywhere close to the max loss. It would be unusual for you to lose more than, say, $200 on a loser, and that's a loser that went well against you, because again, you're managing the trade early. You know, you're only going to really suffer that max loss had you hold the trade all the way to expiration, which is something I never recommend doing. Now, I mentioned we manage the trades at 21 DTE for a winner, for a loser, or for a scratch. If you want to, you can roll the trade out. So in this case, what you could do, if the trade is right around a scratch, so it's a very small profit or it's a very small loss. Typically, if you're somewhere in the ballpark of around break even, just roll that put credit spread out to the new 60 DTE cycle. You'll be able to do it for essentially a credit. You get a little bit of a credit for the roll. As long as you can roll for a credit, you can always roll at 21 DTE out to the new 60 DTE cycle. And here you can see I created this chart. If you're doing these weekly, right, you'll put on the very first put credit spread at 60 DTE. Let's imagine it doesn't get to max profit in 1 week. Well, the next week rolls around, and that first put credit spread you put on is a 53 DTE put credit spread. But then you put on a new put credit spread that's now 60 DTE, right? So now you got 2 put credit spreads on, and you can see you can keep doing this all the way till you get to 21 DTE, where some of them start coming off. In this case, you could have as many as 6 of these on at a time if you do them every week. Now, if 6 of these at one time is too much risk for your account size, instead of doing these every week, do them every 2 weeks, and then the max number that you'll ever have on at one time would be 3. So let's show you put credit spreads in action in the SPYs and the Qs based off of our plan. So let's start with the SPY. I'm going to go and get into the options chain. Now, today is Tuesday, so instead of a 60 DTE cycle, we have a 59-day cycle. But typically, I would go and sell the 35 put and then buy the put $5 below. Now, I'm already in this trade because I just entered this yesterday, but I'll go ahead and put on the same trade as an example. So I'll sell this 35 delta put, and then I go 5 points below and buy that put as the long wing, and this creates a put credit spread. You can see my max profit is 105. I'm receiving a 105 credit. That means my max loss is $5 minus 105 would be $3.95. You can see we're essentially risking 4 to make 1, but remember, because we're exiting the trade early, these are not the real max profit or max loss numbers that we're dealing with. Your probability of profit with this delta, typically you're going to be at around 65% probability of profit, but you can see your probability of making 50% profit on the trade is 92% and 94%. It's fluctuating, but this is why these things are such great trades, is because they have a really high probability of success. They have defined risk. You can only lose so much money. If the market completely crashed tomorrow, the absolute worst loss you could ever take on a put credit spread is the max loss. It's a defined risk trade. So if you're comfortable with the max loss, you're good, right? You're never going to be up at night worrying about, like with a short put or a short strangle that have undefined risk. Those kinds of strategies can make you worry a little bit as a trader, especially when you're a new trader and you don't know how the markets work. You don't have enough experience with it yet. Sometimes starting out with a defined risk trade like a put credit spread really helps keep your mind at ease. And since I've been doing these in both SPY and QQQ since September, I've had 8 winners. I've got 3 more on currently. None of them are currently losing. I've had really good success with these. Now, the market, doesn't just go up all the time. I actually had some pullbacks, where the market had some pretty serious drawdowns where some of my put credit spreads, I put them on and then they immediately became in the money and became losers. But the market, the market tends to drift up. If you hold on a little while, they typically come back to you. And that's been the case with me. These have been very successful. But if you guys want to see just how successful these can be, let's go do a back test. So inside Tasty, they have this back testing feature. And let's actually back test my put credit spread strategy. So let's do SPY and let's do the past 5 years and let's do a put credit spread. And let's choose the strikes that I choose for my plan. I'm doing the 35 delta short put. And then for the long put, I can't do $5 wide, but they will allow me to do a delta. 30 deltas is about $5 wide, where SPY is currently trading. For expiration, instead of 45 DTE, I'm doing 60 DTE for my plan. And then we're going to do these on specific days of the week on Monday. So we're putting a new one on every single Monday. We're going to exit at 21 DTE. We're going to take profit at 50%. Now, this is the plan, right? Let's run this back test for the last 5 years and see how this works. And you can see this has been pretty good. You can see we have a average profit on the trade of 22.63. The return on capital used is 90%. That was very good. How many trades were examined? 225 trades. We won on 184 trades of 225 trades. That is an excellent win rate. And this is just being mechanical, not managing in any way. So there's no rolling here, unfortunately. So actually some of the losses here, you can see there are periods where you lose 3 or 4 in a row. Here's a case where you lose like 7 out of 8 weeks in a row. Now, some of these, you're not a computer doing a back test. For example, if I'm in a losing trade, then maybe I don't put on next week's trade, right? Because I'm still waiting for the trade I'm in to come back. So a lot of the losses, even in the back test, I don't think you're going to take as many losses as what the back test actually tells you. But even running it as a computer, completely mechanical, no management. You put on the trade, it either wins or loses at 21 DTE. This is really good. All right. This is an easy strategy. Again, it's a safe strategy. And I think it's one of the best possible options trading strategies for the beginner options trader. Again, just because it helps keep your mind at ease. You're never risking too much as long as you keep the trade size small. Never have more than 50% of your net lick account value in play at any one time. You always have some cash on the side. As long as you manage your risk appropriately, these put credit spreads are a pretty safe play. Now, if you want to learn more about put credit spreads in SPY and QQQ, come check out the DT Options Discord server. You'll find a link to it in the description below. I hold a live 1-hour voice chat there each and every trading day. We get together, I share my trading platform. You guys get to see all my opening trades, my closing trades. We get to share trade ideas. And if you're new to options trading and you want to learn how to do these put credit spreads in SPY, QQQ, come check out the DT Options Discord server. We'd love to have you. Also, check out my book, The Super Wheel Option Strategy. Of course, it's about my favorite option strategy, the wheel strategy. It also has chapters in there that are great for a beginner options trader because it talks about the Greeks such as delta, vega, and theta. You get to learn about probability of profit and IV rank and a lot of beginner topics. So if you're brand new to options trading, please check out my book, The Super Wheel Option Strategy, available on Amazon. You'll find a link to the book in the description below. Peace, guys.